This is part 3 of accounting for long-term contract. Part 3 of accounting for long-term contract. This segment may be a continuation from the previous video. To understand contract, or to understand revenue recognition on long-term construction contract, we're going to walk through this illustration. Here you see, at the beginning of 2021, the Landmark Construction Company received a contract to build an office building for $5 million. Landmark will construct the building according to the specification provided by the buyer, and the project is estimated to take 3 years to complete. According to the contract, Landmark will bill the buyer in installments over the construction period according to a prearranged schedule. The information is on the screen for 2021, 22, and 23. The construction costs incurred during the year 2021 is 1.5, 22 is 1 million, and 2023, 1.6 million. The total estimated and actual construction costs will be $3.750, $3,750,000 for 2021. For 22, it will be 4 million, and for 2023, 4.1. And the cash collections during that year for 2021 is 1 million. 2022 is 1.4 million, and 2023 is $2.6 million. Now let's look at the accounting for cost of construction and accounts receivable for Landmark for its long-term contract. These journal entries are not affected by the timing of revenue recognition. The first journal entry you see here shows Landmark incurring various costs during the construction process and recording them in an asset account called Construction in Progress, or CIP for short. Now, this asset account is equivalent to work in progress inventory in a manufacturing company. The second journal entry occurs when Landmark bills its customer according to whatever schedule the contract permits. Notice that periodic billings are credited to billings on construction contract. Billings on construction contract. This account is a contra account to the CIP asset. At the end of each period, the balances in these two accounts are compared. If the net amount is a debit, it is reported in the balance sheet as a contract asset and might be named construction in progress in excess of billings or something similarly. Conversely, if the net amount is a credit, it is reported as a contract liability and might be named billings in excess of construction in progress or something similar. Landmark will report an accounts receivable for amounts it has billed the client and not yet been paid, and will report a contract asset computed as CIP billings for the remaining amount of work completed for which it eventually will be paid once it is able to bill the client. Now let's consider revenue recognition. The top portion of this illustration shows the single journal entry to recognize revenue. You have cost of construction. Think of it as cost of goods sold. And gross profit when recognizing revenue upon completion of the contract. While the bottom portion shows the journal entries that achieve this when recognizing revenue over the term of the contract. At this point, focus on the structure of the journal entries, what is debited and what is credited. And we'll discuss how to calculate the specific amounts later. First, the same amounts of revenue, the $5 million contract price, cost, and gross profit are recognized whether it's over the term of the contract or only upon completion. The only difference is timing. To check this, we can add together all of the revenue recognized for both methods over the 3 years. Second, notice that regardless of the timing of revenue recognition, we add gross profit, which is the difference between revenue and cost, to the CIP asset. Regardless of the timing of revenue recognition, we add gross profit to the CIP asset. That seems odd. Why add profit to what is essentially an inventory account? Well, the key here is that when Landmark recognizes gross profit, Landmark is acting, it has sold some portion of the asset to the customer, but Landmark keeps the asset in Landmark's own balance sheet, which is the CIP account, until delivery to the customer. Let me repeat that. The key here is that when Landmark recognizes gross profit, the company is acting like it has sold some of the portion of the asset to the customer, but the company actually keeps the asset in its own balance sheet until delivery to the customer. Now, putting recognized gross profit into the CIP account just updates that account to reflect the total value, which is the cost plus gross profit equals sales price of the customer's asset. But don't forget that the Billings account is contra to the CIP account. Over the life of the construction project, Landmark will bill the customer for the entire sales price of the asset. Therefore, at the end of the contract, the CIP account containing total cost and gross profit and the Billings account will have a zero balance that exactly offset to create a net value of 0. Here in this illustration, if a contract doesn't qualify for revenue recognition over time, revenue is recognized at the point in time that control transfers from the seller to the customer, which typically occurs when the contract has been completed. At that time, the seller views itself as selling the asset and recognizes revenues and expenses associated with the sale. As you see here in this T accounts, completion occurs in 2023 for the Landmark company. Prior to then, CIP includes only costs, showing a cumulative balance of $1.5 million and $2.5 million at the end of 2021 and at the end of 2022, respectively, and totaling $4.1 million. That's the 1.5, the 1 million, plus the 1.6 is where you get the 4.1. is when the project is completed in 2023. Upon completion, Landmark recognizes revenue of $5 million and cost of construction, again, which is similar to cost of goods sold, of $4.1 million because the asset is viewed as sold on that date. If a contract doesn't qualify for revenue recognition over time, revenue is recognized at the point in time that control transfers from the seller to the customer, which typically occurs when the contract has been completed. At that time, the seller views itself as selling the asset and recognizes revenues and expenses associated with the sale. As you see here in the T accounts, completion occurs in 2023 for the Landmark Company. Prior to then, CIP includes only cost, showing a cumulative balance of $1.5 million and $2.5 million at the end of 2021 and at the end of 2022, and totaling $4.1 million when the project is completed in 2023. The $4.1 million is a result of adding the 1.5, the 1 million, and the $1.6 million. Upon completion, Landmark recognizes revenue of $5 million and cost of construction, which is similar to cost of goods sold, of $4.1 million because the asset is viewed as sold on that date. Landmark includes the resulting $900,000 gross profit in CIP, increasing the balance to the $5 million total cost plus gross profit for the project. If a contract qualifies for revenue recognition over time, revenue is recognized based on progress towards completion. How should progress to date be estimated? Well, one approach to estimating progress towards completion is to use output-based measures, like number of units produced or delivered, achievement of milestones and surveys or appraisals of performance completed to date. A shortcoming of output measures is that they may provide a distorted view of actual progress to date. For example, an output measure for highway construction might be finished miles of road, but that measure could be deceptive if not all miles of the road require the same effort. A highway contract for the state of California would likely pay the contractor more for miles of road blasted through the mountains than for miles paved across flat desert. Another shortcoming of some output measures is that the information they require, such as surveys or appraisals, might be costly to obtain. Another way to estimate progress is to base it on the seller's input, measured as the proportion of effort expended thus far relative to the total effort expected to satisfy the performance obligation. Measures of effort include costs incurred, labor hours expended, machine hours used, or time lapse. The most common approach to estimating progress toward completion is to use the cost-to-cost ratio that compares total costs incurred to date to the total estimated cost to complete the project. Now let's assume that landmark project qualifies for revenue recognition over time and consider the calculation of revenue each year based on progress to date estimated using the cost-to-cost ratio. Notice that this approach automatically includes changes in estimated cost to complete the job and therefore in estimated percentage completion by first calculating the cumulative amount of revenue to be recognized to date and then subtracting revenue recognized in prior periods to determine revenue recognized in the current period. Here in this illustration, the allocation of revenue to each period. First, the cumulative amount of revenue to be recognized to date is calculated, and then revenue recognized in prior periods is subtracted to determine revenue recognized in the current period. We can see that each year, the journal entry recognizing revenue over the contract period serves to update CIP to include that year's gross profit. At the end of the contract, CIP includes all costs and all gross profit. So it includes total revenue of $5 million, exactly equal to the $5 million billed to the customer. So we end up in the same place regardless of whether revenue is recognized upon completion or recognized over time. The only thing that differs is timing. Here we can see recognition of revenues, cost of construction, and gross profit in each period of the contract. In 2021, you see that revenue recognized was $2 million. The cost of construction was 1.5. So the gross profit for 2021 is 500,000. In 2022, revenues recognized was 1.125. The cost of construction was a negative 1 million. So the gross profit was $125,000. In 2023, revenue recognized to date, 5 million times the 100%, meaning that it's completed, and less revenue recognized in 2021 and 22. You add those two totals for the year and you get 3.125. So the total revenue recognized is $1,875,000. The cost of construction is $1.6 million. So the gross profit for 2023 is $275,000. Here in this illustration, it shows that after the job is completed, after the job is finished, the only task remaining is for Landmark to officially transfer title to the finished asset to the customer. At that time, Landmark will prepare a journal entry that removes the contract from its balance sheet by debiting Billings and crediting CIP for the entire value of the contract. The same journal entry is recorded to close out the billings on construction contract and CIP accounts where the revenue is recognized over the term of the contract or at the completion of the contract. In the balance sheet, the construction in progress, the CIP account, it is offset against the billings on construction contract account with CIP. Billings viewed as a contract asset and labeled as CIP in excess of billings. CIP is viewed as a contract liability and labeled as billing in excess of CIP. When revenue is recognized over the term of the contract, CIP contains cost and gross profit. If revenue is recognized upon the completion of the contract, CIP typically contains only costs. Because a company may have some contracts that have a net asset position and others that have a net liability position, it is not unusual to see both contract assets and contract liabilities shown in a balance sheet at the same time. CIP in excess of billings is treated as a contract asset rather than an accounts receivable because something other than the passage of time must occur for the company to be paid for that amount. Although Landmark has incurred construction costs and is recognizing gross profit over the term of the contract for which it will be paid by the buyer, those amounts are not yet billable according to the construction contract. Let's check your understanding. Landmark Construction entered into a contract to construct a tunnel for a fixed price of $12 million. Landmark recognizes revenue over time according to percentage of completion. Here are the facts. Costs incurred for 2021 is $3 million. Cost to complete is $6 million. In 2022, cost incurred is $500,000. Cost to complete is $6.5 million. And 2023, cost incurred is $6.5 million. Cost to complete, of course, is $0 because it's finished, or it should be finished. What is Landmark's percentage completion in 2022? What is Landmark's percentage completion in 2022? And the answer is B, 35%. That's the $3 million plus the $500,000 divided by the $3 million plus the $500,000 plus the $6.5 million equals 35%. Here's another, check your understanding. Landmark Construction entered into a contract to construct a tunnel for a fixed price of $12 million. Landmark recognizes revenue over time according to the percentage of completion. Here are the facts. In 2021, cost incurred is $3 million. 2022, $5 million. 2023, $2.5 million. The cost to complete in 2021 is $6 million. 2022 is $2 million. What is Landmark's percentage completion in 2021? What is Landmark's percentage completion in 2021? And the answer is B, 33.33%. And you should arrive at that number by dividing 3 million by the 3 million plus the 6 million, which will give you 33, or 1/3 complete. Here's another check your understanding. Same information. What is Landmark's percentage completion in 2022? What would be Landmark's percentage completion in 2022, given the facts that you see on the screen? And the correct answer is C, 80%. And you should arrive at that percentage by adding the 3 plus the 5 million, which is the 8 million, divided by 3 million plus 5 plus 2 will give you the 80%. 80% complete. Here's another check your understanding. Landmark Construction entered into a contract to construct a tunnel for a fixed price of $12 million. Landmark recognizes revenue over time according to the percentage of completion. And the facts are as shown on the screen. How much revenue would Landmark recognize in 2021? Based on the information that you see, how much revenue would Landmark recognize in 2021? And the answer is A, $4 million. Landmark will recognize $4 million revenue in 2021. And you would arrive at that answer by dividing 3 million by the 3 million plus 6 million, which will give you the 33.33%, and the 12 million times 1/3, or 33%, will give you the $4 million revenue recognized in 2021. Here's one for 2022. How much revenue would Landmark recognize in 2022? How much revenue would Landmark recognize in 2022? The same information is given. So the answer is B, $5.6 million. And you should arrive at that answer by adding the 3 plus 5 million divided by 3 million plus 5 million plus 2, which will give you that 80%. And then when you multiply the 12 million by the 80%, it should give you $9.6 million total revenue to date. However, you have to use that 9.6 million and subtract the 4 million from it, which will give you the $5.6 million. And that's the revenue recognized in 2022. The next screen will ask for the 2023 revenue for Landmark Construction. How much revenue would Landmark recognize in 2023? And the answer is $2.4 million. Landmark should recognize $2.4 million in 2023. And you would arrive at that information by multiplying the 12 million times the 100%, which is, of course, this is 12 million total revenue to date. Then your 12 million minus the 4 million in 2021, plus the 5.6 million in 2022 will give you the $2.4 million. Unfortunately, losses sometimes occur on long-term contracts. As facts change, sellers must update their estimates and recognize losses if necessary to properly account for the amount of revenue they should have recognized to date. Now, how to treat those losses in any one period depends on whether the contract is profitable overall. A loss could either be a periodic loss that occurs for overall profitable project or projected on the entire project. Then you would have to consider the periodic losses only if the revenue is recognized over time, but you also have to consider overall losses regardless of the timing of the revenue recognition. When a project qualifies for revenue recognition over time, a loss sometimes must be recognized in at least one period along the way, even though the project as a whole is expected to be profitable. Now, you can determine the loss in precisely the same way you determine the profit in profitable years. So at the end of 2021, you see that there's a 40% of the project is complete. That's the 1.5 million divided by $3.750,000. Now, revenue of 2 million, the cost of the construction of 1.5 equals the gross profit of $500,000, is recognized in 2021. Now, at the end of 2022, though the company now forecasts a total profit of $400,000. That's the 5 million minus the 4.6 on the project. And at that time, the project is estimated to be 60% complete. And that's the 2.760, the 2,760,000 divided by the 4.600,000, which will give you the 60%. And then you see that the 2022 revenues equal the 5 million times the 60% minus the 2 million equal the $1 million. And here you see the journal entry for those transactions. The cost of construction is debited for 1,260,000. Revenue from long-term contract is credited for 1 million, and construction in progress is credited for $260,000. Of course, if revenues is instead recognized upon the completion of the contract rather than over time, no profit or loss is recorded in 2021 or 2022. Instead, revenue of $5 million, cost of construction of 4.6 million, and gross profit of 400,000 are recognized in 2023. Now, let's change the facts again to reflect the loss on the entire project. Notice that in 2022, the estimated total cost of $5.1 million exceeds total estimated revenue of $5 million. In 2023, there is more bad news, because there's an additional $100,000 of cost before the project is completed. And here in this example, allocation of revenue and cost of construction to each period, we're talking about loss on the entire project. Let's start by considering how overall losses on a contract are recognized when revenue is recognized over time. Each year, you would calculate the revenue to be recognized in the normal fashion, multiplying total revenue to be recognized by the percentage of completion. In situations where a loss is expected on the entire project, you have to back out any gross profit recognized in prior periods and also recognize the overall loss. Then you would back into the cost of construction by adding the amount of the loss recognized to the amount of revenue recognized. For example, you see in 2022, Landmark has to back out gross profit of $500,000 recognized in 2021 and add to that amount the $100,000 overall loss it thinks will occur on the contract. So the total gross loss to be recognized in 2022 is $600,000. Revenue recognized of $706,000 is added to the gross loss of $600,000 to arrive at the cost of construction of $1.3 million. That's $1,306,000. Recognizing revenue over time in this case produces a large overstatement of income in 2021 and a large understatement in 2022 because of a change in the estimation of future costs. These estimate revisions happen occasionally when revenue is recognized over time. In 2023, the income statement will report revenue of $5 million and a cost of construction of $5.1 million, combining for an additional loss of $100,000. And here you see all the journal entries to record the losses in 2022 and 2023. The cost of construction is debited for $1,306,000. Revenue from long-term contracts and construction in progress is credited for $706,000 and $600,000 respectively. In 2023, cost of construction is debited for $2,394,000. Revenue from long-term contracts and construction in progress are credited $2,294,000 and $100,000 respectively. When the contract does not qualify for recognizing revenue over time, no revenue or cost of construction is recognized until the contract is complete. In 2022, a loss on long-term contracts an income statement account of $100,000 is recognized. In 2023, the income statement will report revenue of $5 million and a cost of construction of $5,100,000, combining for an additional loss of $100,000. This is the end of part 3, accounting for long-term contracts.